very good morning Abi to Miss Siti Maliza Saleh and all my friends. Today, we will be presenting the first topic, which is understanding the business ethic. First, I will show what is the learning outcome from this chapter. So what is important in this chapter? The first one is ability to explain 13 factors affecting public expectation for business behavior. Second, be able to explain the new expectation for business. The third one, understand the concept of Milton Friedman theory about making a profit. Next, able to explain the fiduciary role and the ethic environment for professional accountant. Lastly, applying ethic in business and governance in the future. First of all, we must know what is the definition of business ethic. Business can be defined as commercial or mercantile activity engaged in as a means of livelihood. According to Merriam-Webster.com, business also is an activity of making, buying, selling goods or providing services in exchange for money. What is ethic? Ethic can be defined as the discipline dealing with what is good and bad and with the moral duty and obligation. Ethical behavior is being honest, truthful and doing the right thing even at the expense of self-interest. By combining these two words, business ethic can be defined as a set of moral principles that act as a guideline for conducting the business transaction. It is a set of principles that determines what is right, what is wrong and appropriate in the workplace. Furthermore, business ethic can influence every employee, including the interpersonal relationship with the company, as well the business relationship with the external customer. Next, what is the importance of a good ethical conduct? There are four. So the first one is the asset protection. A strong ethical culture within your business is important in safeguarding your asset. Employees who obey the workplace ethic will be able to protect and respect the business asset. Second one, the public image. Company can earn a lot of respect and cultivate a strong image in the public domain when they make ethical choice. For instance, you can fulfill your corporate social responsibility by reducing waste discharge from your business. Next, productivity and teamwork. Workplace ethics is integral in fostering increased productivity and teamwork amongst the employees. Ethics enable the employees to feel a strong alignment between their value and the business transaction. The employees will show such feeling through increased productivity and their motivation. Lastly is the decision making. Ethical conduct in the workplace encourages a culture of making decisions based on ethics. It also enhances accountability and transparency when undertaking any business decision. So the first learning outcome is ability to explain 13 factors affecting public expectation of business behavior. What is the 13th factor? The first one is the unbridled greed. Second, physical. Third, moral. Fourth, bad judgment. Fifth, activist stakeholder. Sixth, environmental reality. 7, economic. 8, competition. 9, financial malfeasance. 10, governance failure. 11, accountability. 12, synergy. And lastly is the institutional reinforcement. The first factor is unbridled greed. What is unbridled greed? Unbridled greed is an uncontrolled desire to have something that you need. As an individual wealth and status rise, so does their tendency to be unethical. Example of corporate greed is the dishonest bank who give people mortgage that the banks know that they cannot afford just so that the bank can make money and foreclosure on the house. Second one is the scam. The scam to steal money from investor, also known as a Ponzi scam. I bet you guys heard of Ponzi scam because it is one of the famous scam in our country. What is Ponzi scam? It is a scam that leads victims to believe that profits are coming from the legitimate business activity. The scammer usually promise return as high as 3% to 6%. To make the system current, the operator link to the hot investment like gold, oil, private equity, forex, and other. Next factor is physical. Physical content of environmental concern. It is the quality of air and water. There are two examples of pollution. The first one is the air pollution. Air pollution centers on smokestack and exhaust pipe smoke which cause respiratory irritation and disorder. What is the effect of air pollution? The first one is the acid rain. Acid rain caused by the nutrient lack and defoliate trees. Second effect is the dissipation of the Earth's ozone layer. The release into the atmosphere of CFC and cutting down trees has replacing the ozone layer. So next pollution is a water pollution. What is water pollution? It is polluted by both natural as well as a human-made activity such as volcanic eruption, earthquake, tsunami are known to alter water and contaminate it. The first effect of water pollution is the destruction of biodiversity. It affecting the ecosystem that exists underwater. Second effect is the contamination of the food chain. For instance, fishing in a polluted water and use of the water waste for the livestock farming and agriculture can introduce toxic into food, which are harmful to our health when eaten. Need for sustainability is the growing concern for local and global environmental sustainability has led to competitive and activist pressure for companies to report publicly on their environmental impact using sustainability framework. The third factor is a moral sensitivity. Beginning in the 1980s and 1990s, there has been a significant increase in the sensitivity of the lack of fairness and discrepancy in equitable treatment normally afforded to individuals and groups in society. The desire for equity in employment, to pay scales for the women and men, campaign to boycott buying from corporations that engage in child or sweatshop labor in foreign countries, such as the creation of codes of ethical practice for supplier and compliance mechanism to ensure they must follow. The public expected the businesses to practice moral sensitivity by not to employ child or sweatshop. Second, treating everyone equally no matter what gender you are. Lastly, respecting other religion, belief, and race. Next factor is economic. The public expect businesses to act in a good faith even they are put under pressure by the economic recession and faced with great business competition. Absence of growth and shrinking margin lead to downsizing to maintain overall profitability and desirability to capital market. For example, some irresponsible shopkeepers did hide stock of cooking oil for the purpose to increase the price in times of limited supply. Coronavirus or COVID-19 has negatively impacted businesses all over the world. The COVID-19 pandemic outbreak has caused many businesses to close. On top of that is the financial malfeasance. The public expects businesses to act honestly and should never be involved in the financial scandal. The manager of the company hiding the financial reality of the company, which can lead to an accounting scandal that hurt the shareholder. There are two gaps. The first one is the expectation gap. Expectation gap can be described as the difference between what the public thinks it is getting in audited financial statement and what is actually getting. Tighter the regulation, higher fines, and investigation into the integrity, independence, and role of the accounting and auditing profession, and more recently of executive and director. Then, credibility gap. What is credibility gap? It is continuing financial malfeasance has led to a crisis of confidence over corporate reporting and governance. It is to promote the integrity of the corporation and increasing fines and regulation all testify to the importance being assigned to this crisis. Example of financial malfeasance is the first one, management board involvement in fraud or corruption have resulted collapse of corporation. The shareholder affected by this incident. Because many cases are reported, it can tarnish trust of the public towards the management board of the company. Next is accountability. The public expect companies and businesses to be accountable for their products, like in the case if they discover defect, then those must be recalled. For example, in the case of Johnson & Johnson, recalled around 33,000 bottles of baby powder in the United States after the Food and Drug Administration said that they found a trace amount of asbestos, a non-carcinogen, in a bottle purchased online. The Johnson Company retested and confirmed that the Johnson baby powder has found no sign of asbestos, prompted the recall. Second case is the Ford Company. Ford is recalling over 154,000 Ford Ranger pickup truck, Ford Mustang, Ford Edge, Lincoln, MKX SUV, Ford Fusion, and Mercury Milan because they may have faulty Takata airbag inflators installed during repairs.
For the seventh factor, which is governance failure, the Enron, Arthur Andersen, and WorldCom series of disaster in 2001 until 2002 proved that the current regulatory and monitoring frameworks were insufficient to protect investor interests and more generally the public interest in orderly markets and corporate activities. To protect the public interest, governance reform was seen as essential, whereas previously directors were required to evaluate and ensure that their corporation's risks were adequately handled. Ethics risks were now seen as an important part of the process. It was simply too late for governance reform to ensure that this would happen. Due to the incident of the Enron, Arthur Andersen, and WorldCom, the public expects government to play its corporate governance roles in serving the public. For the eighth factor, which is institutional reinforcement, as a result, the public's consciousness influences politicians who react by drafting new laws or tightening regulations. In effect, the many problems that have come to the public's attention result in institutional reinforcement and codification in the law of the land. The multiplicity of ethical issues has refocused attention on the need for more ethical action. The public expects regulatory institutions to investigate any irregularities and straighten laws so that the public is not suffered by the villains in business. The creation of the IFRS and the Code of Ethics for Professional Accountants are the focal points for harmonizations worldwide. For the ninth factor, which is competition, because of the growth of global economies, products are now manufactured and sourced all over the world. With lower rates of domestic workers, the resulting restructuring has been viewed as allowing greater competitiveness and lower costs. Therefore, the burden on working people to keep their job does not ease as demand rises. Nor given the greater competition, greater volume would not always increase profit. So the burden on companies will not return to normal to previous levels. Increasing competition also have its cons. For example, the company sells counterfeit goods by claiming it is original or making sales near the expiry date. Because of this kind of competition, the public expects businesses to practice healthy business competition without burden the workers or deceive the customers. For the tenth factor, which is synergy, synergy is when two or more people or organizations combine their efforts, they can accomplish more together than they can separately. The need for improved mechanism and controls to avoid unethical corporate behavior has become more commonly acknowledged. The public is concerned about the consequences of businesses' unethical behavior on society, so they expect businesses to be more careful in their actions. This also impacts politicians who react by preparing new legislation or tightening regulations. The example of synergy is IASB and IFAC creates the International Financing Reporting Standard and the Code of Ethics for Professional Accountants. The 11th factor, which is bad judgment. As a human being, it is normal that we make mistakes. Sometimes the public or specific groups feel offended at this instance of bad judgment and take actions to inform the directors and management that they do not approve. For example, Nestle products were boycotted in North America and Europe to stop free distribution because the African mother mixing the baby formula powder with contaminated water. For the 12th factor, which is activist stakeholders, there are two types of activists, which are ethical investors and ethical consumers. For ethical investors, they took the view that their investments should not only make a reasonable return, but should do so in an ethical manner as well. While for the investor consumers, they're interested in buying products and services that were made in ethically acceptable manner. For the final factor, which is environmental reality, as we can see, most of the time government will take action if there is a disaster happen. This has been significant at all levels. More recently, the growing concern for local and global environmental sustainability has led to competitive and activist pressures for companies to report publicly on their environmental impacts using sustainability frameworks such as the Global Reporting Initiative G4 guidelines. Public expects businesses to take care of the environment and set aside budgets for purposes of improving the environment. So, the cloud that surrounds me, ting, 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 are the examples activities that the government has done to save the environment, such as replanting trees, No Plastic Bags Day, 3R campaign, and Save the Turtle campaign, which is prohibits the using of plastic straws.
My presentation today will be about learning outcome 2, which by the end of my presentation we should be able to explain the new expectation for business. The new expectation for business consists of three parts, which is the new mandate for business, new governance and accountability framework, and reinforced fiduciary role for professional accountants. The changes in public expectations have triggered in return an evolution in the mandate for business. The laissez-faire, profit-only world of Milton Friedman has given way to the view that business exists to serve society, not the other way around. For some, this may be stating the degree of change too strongly, but even they would concede that the relationship of business to society is one of interdependence, where the long-run health of one determines that of the other. In many forums, Milton Friedman made the following case. In a free enterprise private property system, a corporate executive has the responsibility to make as much money as possible while conforming to the basic rule of society, both in law and in ethical custom. This is the appropriate way to determine the allocation of scarce resource to alternative uses. Now, let's move on to learning outcome 3, which is to understand the concept of Milton Friedman's theory about making profit. There are many arguments for and against this position. Three critical issues deserve mention. First, there are that the deviation from a profit-only focus does not mean that profit will fall. In fact, profit may rise. Second, profit is now recognized as an incomplete measure of corporate performance and therefore inaccurate measure for resource allocations. And third, Friedman explicitly expected that performance would be within the law and ethical custom. First, there is the myth that business could not afford to be ethical because too many opportunities would be given up for profit to be maximized, or that executives could not afford to divert their attention from profit or else profit would fall. In fact, research studies exist that show short-term profits increasing as well as decreasing when social objectives are taken into account by executives. However, long-term perspectives also strengthen the case that social and profit goals can make profitably. A study performed by Clarkson in 1988, which ranked the social performance of 60-plus companies on a modified Worthick and Cochrane scale, and found that above average social performance is positively correlated with profit. The second aspect of Friedman's argument that has eroded since it was first proposed is the accuracy in which profit guides the allocation of resources to their best use for society. In 1970, when Friedman began to articulate the profit-resource linkage, there was virtually no cost ascribed to the air and water used in the manufacturing process, nor was a significant cost ascribed to the disposal or treatment of waste. The costs of these so-called externalities have skyrocketed, and yet they are still not fully included in calculating the profit for the year for the polluting company. As the cost associated with these and other externalities rises, the profit-resource use linkage promises to become less and less useful unless the framework of traditional profit computations is modified or supplemented. Finally, Milton Friedman himself expressed the view that profit should be sought within the laws and ethical customs of society. This is not appreciated by many who argue for profit only in its strongest laissez-faire, bare-knuckled form. Obviously, chaos would result if business were carried in an absolutely no-holds-barred environment. A minimum framework of rules is essential for the effective, low-cost working of our markets and the protection of all participants. Increased regulation is one response to outrageous behavior or the increasing ethical needs of society. What most profit-only advocates fail to see is that the alternative to increasing regulation by government is an increasing self-emphasis on better ethical governance and behavior. Based on this analysis, successful corporations are best served by governance and accountability mechanisms that focus on a different and broader set of fiduciary relationships than in the past. The allegiances of directors and executives must reflect the stakeholder interests in terms of goals, processes, and outcomes. Governance objectives and processes must direct attention to these new perspectives, and modern accountability frameworks should include reports that focus on them. If not, the public's expectations will not be met, and regulations may be created to ensure such attention and focus.
My name is Romina Ana Ujai, and Now I will proceed with the next part of our presentation, where I will explain about learning outcome number 4. In this section, students should be able to explain the fiduciary role and the ethics environment for professional accountants. The public's expectation for trustworthy reports on corporate performance cannot be met unless the professional accountants focus their primary loyalty on the public interest and adopt principles such as independence of judgment, objectivity, and integrity. So consequently, primary fiduciary responsibility of professional accountants must focus on public or public interest. Otherwise, expectations of stakeholders in society will not be met and credibility of the corporation will erode, as well as the credibility and reputation of the accounting profession. Next, we'll move to responses and development. There are 4 important things that we have to know under this subtopic. The first one is emerging governance and stakeholder accountability models. Next, management based on values, reputations, and risks, accountability, and the last one is ethical behavior and development in business ethics. The first part that I will explain is about emerging governance and stakeholder accountability models. There are several other important trends developed as a result of economic and competitive pressure that had and that continue to have an effect on the ethics of business and therefore on the professional accountants. These trends included the following. The first one is expanding legal liability for corporate directors and ultimately the CEO and CFO, as well as management accessions to shareholders on the adequacy of internal control and a stated intention to manage risk and protect reputation. So these 3 trends have given significant changes, such as delaying employee empowerment and the use of electronic data interfaces, and increased reliance by management on non-financial performance indicators used on a real-time basis. So, the next part is about management based on values, reputation, and risk. In order to incorporate the interests of stakeholders into the policies, strategies, and operations of their corporation, directors, executive managers, and other employees must understand the nature of their stakeholders' interests and the value that underpin them. A hypernorm is a value that is almost universally respected by stakeholder groups. Therefore, if a company's activities respect a hypernorm, the company is likely to be respected by stakeholder groups and will encourage stakeholder support for the company activities. Hypernorms include the demonstration of the following values such as honesty, compassion, predictability, fairness, integrity, and responsibility. Besides that, the reputation of the company and the degree of support gathered from stakeholders will depend on this understanding, on the ability of the company to manage the risks facing the company directly as well as those impacting its stakeholders. Reputation includes the following values such as credibility, reliability, trustworthiness, and responsibility. Next is risk. Risk is defined as the chance of something happening that will have an impact on objective. So, management and auditors have become increasingly risk management oriented since the mid-1990s. The techniques have been developing in identifying risks early and in planning. So, this is to avoid or mitigate the unfortunate consequences inherent in the risk. There are 2 types of risk. The first one is risk management, which includes the culture, process, and structure that are directed towards the effective management of potential opportunities and adverse effects. Next is risk management process, which include the systematic application of management policy, procedures, and practices to the task of establishing the content, identifying, analyzing, assessing, managing, monitoring, and communicating risk. Next part is about accountability. The needed improvement in integrity, transparency, and accuracy has motivated the discussion among accountants about the nature of the guidelines they should follow in the preparation of report, rules, and principles. So, what is meant by integrity? Integrity is when some issues are not covered, nor is there always a clear, balanced presentation of how the interests of stakeholders will be affected. As for transparency, it is an obtuse or unclear manner that the lack of transparency will cloud the understanding of the reader. So the financial report, rules and principles have to be transparent. Accuracy is a faithful representation that is fundamental to an understanding of the underlying effects. So every report, every rules, and every principle that is prepared by a professional accountant should be accurate. Okay, now we will move on to the next part, which is the ethical behavior and development in business ethics. Some philosophers has defined ethical behavior and the lesson that they have learned over the centuries. The first one is the German philosopher Immanuel Kant. He believed that people are ethical when they do not use other people opportunistically and when they do not act in a hypocritical manner, demanding a high level of conduct for everyone else while making exception for themselves. Unfortunately, there are many instances of organizations that do not live up to this standard. Some treat employees, customers, and suppliers merely as a means, exploiting them for some short-term goals. The Greek philosopher Aristotle argued that the goal of life is happiness, and happiness is achieved by leading a virtuous life in accordance with reason. Some of these virtues include integrity, honor, loyalty, courage, and forthrightness. In a business sense, this means that directors, executives, and accountants should demonstrate integrity in all their business dealing. They should honor the terms of contracts rather than look for loopholes. They should be loyal to their employees, customers, and suppliers. They should have the courage to be candid and transparent in their dealings with relevant stakeholders. Next, the English philosopher John Stuart Mill. He argued that the goal of life is to maximize happiness and to minimize unhappiness or pain. And the goal of society is to maximize the social benefit to all people. Degrees of happiness can be both physical and psychological. So, this theory implies that the goal of business is to contribute to increasing the physical and psychological benefits of society. This does not mean that the goal of business is to maximize its profit. Rather, the goal of business is to contribute to the overall good of society. The last one, the American philosopher John Rawls, contends that society should be structured so that there is a fair distribution of rights and benefit, and that any inequalities should be to everyone's advantage. This implies that businesses act in an ethical manner when they do not have discriminatory prices and hiring system. The ethical principles developed by philosophers provide insight into the key dimensions of ethical reasoning. Decision makers should understand three basic philosophical approaches, which are the consequentialism, deontology, and virtue ethics. Consequentialism requires that an ethical decision have good consequences, while for deontology holds that an ethical act depends on the duty, rights, and justice involved. And virtue ethics considers an act ethical if it demonstrates the virtue expected by stakeholders of the participants. The first practical analytical approach, known as the modified 5-question approach, involves challenging any proposed policy or action with 5 questions designed to rate the proposal on the following scale: profitability, legality, fairness, impact on the rights of each individual stakeholder, and on the environment specifically, and the demonstration of virtues expected by stakeholders. The modified moral standards approach, originally developed by Velasquez in 1992, focuses on 4 dimensions of the impact of the proposed action. The first one is whether it provides a net benefit to society, whether it is fair to stakeholders, whether it is right, and whether it demonstrates the virtues expected by stakeholders. The last approach to stakeholder impact analysis presented in Chapter 4 is the modified PASTID approach, which extends the moral standard approach by specifically taking account of the culture within the corporation and of so-called common problems. The use of stakeholder impact analysis in management decision-making and in the management of contentious issues will contribute significantly to stakeholder concept and corporate social concept. There are 3 important things that you have to take note under the ethics environment for professional accountants. The first one is role and conduct. Next, governance and services offered. Professional accountants owe their primary loyalty to the public interest, not just to their own financial interests, company, directors or management, or current shareholders at the expense of future shareholders. The public expects all professional accountants to respect the professional values of objectivity, integrity, and confidentiality, which are designed to protect the fundamental rights of the public. As for conduct, an employee accountant must respond to the direction of management and the needs of current shareholders. In the accounting profession, there is a movement to a globally harmonized set of generally accepted accounting and auditing principles, known as GAAP and GAS, to provide analytical efficiencies for the providers of capital to the world's market and computational and audit efficiencies around the world. Concurrently, IFAC has developed an international code of ethics for professional accountants, and all IFAC member countries have agreed to standardize their country's code on the same or a similar basis to the new international code. The details of this international code are reviewed in Chapter 6. Services offered is the offering of non-audit services to audit clients have been curtailed or reduced so that tighter conflict of interest expectation can be met. The advent and growth of multidisciplinary firms in the late 1990s, which included professionals to provide a broader range of assurance and other services to their audit clients, has also been reduced by revised SEC and other standards. So several major audit firms have redeveloped specifically directed consulting services. So this is the end of my presentation. Now I will pass the next presentation to our next presenter. Thank you.
I am Naanisa binti Ali and I will present the learning outcome number 5 for chapter 1, which is applying ethics in business and governance in the future. Now I would like to present the purpose of ethics in business and accounting profession. First, it is to relate accounting education to moral issues in business context. Second, to develop the skills to deal with the ambiguities of accounting profession. Third is to provide the members of the profession with the tools to take decisions that have ethical implications. The next purpose is to develop a sense of moral obligation and responsibility. And the last one is to develop the skills required to deal with ethical conflicts and dilemmas. Next, we look at the fundamental principle of ethics for professional accountants. There are 5 principles. First, integrity. Professional accountant has to be straightforward and honest in all professional business relationships. Second, confidentiality. They are required to respect the confidentiality of information acquired as a result of professional and business relationships. Third is objectivity, which means not to compromise professional or business judgment because of bias, conflict of interest, or undue influence of others. Next is professional competence and due care. They have to attend and maintain professional knowledge and skill at the level required, and act diligently in accordance with applicable technical and professional standards. And lastly, professional behavior. They are required to comply with relevant laws and regulations and avoid any conduct that the professional accountant knows or should know might discredit the profession. Next, we look at how to manage ethic risks and opportunities. There are 2 ways, which is development of integrity and corporate governance. First, we look at the developing a culture of integrity. The most effective way to manage ethic risk and opportunity is to ensure that integrity is part of the decision-making culture of the firm. Lynn Sharpayne has suggested 5 essential elements that are required to develop an organizational culture of integrity and ethical behavior. Number 1 is to clear communication. Ethical values and standards must be clearly and disseminated to all employees so that everyone knows that the firm is committed to integrity. Another principle is personal commitment by senior management. The firm cannot merely expose that ethics is important. Instead, senior management must be willing to make difficult ethical decisions and then assume personal responsibility for their decisions. Third principle is integration. Ethical values, norms, and standards must become part of the normal everyday activities and become routines of the firm. Next, ethics must be reinforced. Information systems and compensation structures should be designed to ensure that ethical behavior becomes the norm rather than the exception to the rule. And lastly is education. Continuous learning programs such as ethics training help employees to develop the competencies required to make ethical decisions on a daily basis. Now we look at the second way to manage risk and opportunity, which is corporate governance. Under corporate governance, guidance is provided for the process of ethic risk identification, while caution is advised against over-reliance on external auditors for the process of ethic risk identifications. And insights are offered for the management and reporting of ethic risk. Effective strategies and mechanisms for influencing stakeholders are discussed with the view of developing and maintaining their support. Linkages are made between ethic risk management and traditional environmental scanning. A company cannot develop an effective culture of integrity if its personnel engage in improper behavior. Therefore, preventive measures should be put in place to avoid serious losses. These must be based on an understanding of the motivations and rationalizations. Business and professional accounting inevitably depend on people. Understanding expectation for workplace ethics is extremely important to the success of all organizations and their executive. Other than that, development of trust, which depends on ethical values, is so important to communications, cooperations, and sharing of ideas. Part of the ethical puzzle for modern corporation to sort out is the giving and receiving gift, bribes, and facilitating payments. In order to enforce anti-bribery statutes worldwide and to collect huge fines, directors, management, employees, and agents have to understand and apply the discussions on bribery, whistleblowing, and white-collar crime. Now we move to the framework for studying business and professional ethics for accountants. For the framework, we have to know the overview of business, objective, and processes that must be direct attention to the perspective. Ethical issues can be mandatory and voluntary. Ethical decision-making process and factors that influence decisions are also important. And next, to ensure public's expectations are met, regulation may be created. So under the ethical decision making, we see the definition for ethic and business ethics. Ethics here means the character, spirit, or attitude of a group of people or culture, while business ethic is a form of professional ethic that examines ethical principles and moral ethical principles that arise in business environment. For moral reasoning, it is associated with the norms, values, and beliefs embedded in social processes that define right or wrong for one individual or a community. Here are the 4 professional ethics for accountants. First, professional accountants must obtain an accounting qualification and acquire a certain level of skills and experiences. Next, competent professional accounts in business are diverse, working in industry, financial services, education, and public and not-for-profit sectors. Third is influenced by technology, greater regulation, increasing globalization, and even increasing risk. And the last one must be able to employ an inquiring mind to their work, founded on the basis of their knowledge of company's finance and using their skills and intimate understanding of the company and environment in which it operates. Okay, that's it for chapter 1. Now we look at the past year question analysis for this chapter. For last semester, there is one question on business ethics where the question will give us the statement and we will have to identify which one is false. It contains 1 mark and it is in multiple choice question form. For July 2020, it comes out in both MCQ questions and short essay question. Here we can see that both questions ask us about Milton-Friedman theory. Next, in December 2019, there are 2 questions on this chapter. One asks us about the factors that affect the public expectation for ethical business behavior, and another one asks for Milton-Friedman theory again. In June 2019, again, the factors that affect public expectation is being asked. Now we look in December 2018. The question is about Milton-Friedman theory. And next in June 2018, the factors that affect public expectation comes out again. In January 2018, both the factors affecting public expectations and Milton theory being asked again. In July 2017, the question asked on the factors that affecting the public expectation. So from what we already see in all the past year's questions, we can conclude that the factors affecting public expectation for ethical business behavior and Milton-Friedman theory is the most popular questions for this chapter, which means that they are very important and we really have to understand these two. That's all from us, Group 1.